I don't know about last lecture. I think the audio file crashed about halfway through the discussion, and so if that's the case, somebody let me know, and I'll clip it from another class where I taught that same exam and put that in there. I posted it up, but my sense was that there's something wrong with the audio on that at some point. But anyway, okay, so let's just go ahead and let's take a look at the slides from Chapter 7. And not much of a opening slide there, just starts right with you drinking from a fire hose here, talking about the different types of receivables, okay? And in this chapter, this class, we are really going to focus on these first two, which you already know about accounts receivable. You really already know about notes receivable, okay? So what we're going to be learning about, though, is what happens when you give somebody a service, you provide somebody a service, or you sell somebody your goods, and you let them take those items on credit. Okay, so if we have sales of $100,000 on credit, who wants to give me the journal entry for that? Sale on credit. Sale on credit. Yeah, we have a sale on credit. I'm going to credit something. You got that right. So I have sales on credit, so what do you want me to credit? Okay, good. So I'll credit the sales. Good. What's your name again? Sabrina. I'm going to go ahead and credit the sales. Okay, good, Sabrina. And then that's 100,000. What do you want me to credit? What do you want me to debit? Accounts receivable is going to get debited, right? For 100,000? Okay, good. Now, what happens? Did this person give me any cash yet? Do we know for sure that this person is going to pay me 100,000 cash? We hope so, but there's a chance. There's always a chance that somebody's going to fall on hard times, whatever, and not be able to pay me the cash when it's due, right? In fact, they may not be able to pay me that at all. Isn't that true? Okay. So what happens? The FASB, not the Governmental Accounting Standards Board, but the Financial Accounting Board looked at that, and they said, well, look, if that's the case, then we're going to assume that there's somebody that is not going to pay you, and you're going to have to make up the receivable. Guys, I promise you, I will always bust you out when you're doing something other than accounting in this class. Every single time. You don't know. I can see the look when you're studying accounting is like this. Okay, when you're looking at someone else, something else, the look is all... it's a wild contrast between the two, okay? So from my point of view of the room, okay? So just stay focused on what we're talking about in here. It's not that long of a class, and then you can go on the rest of your day doing whatever, okay? And while we're in here, we're focusing on this with the lesson, okay? So what happened? The Financial Accounting Standards Board looks at that, and they sit there and they say, well, we're going to assume that people aren't going to be able to pay you everything because it happens all the time, right? Okay? So if somebody's not going to pay me this $100,000, what journal entry should I make for the possibility that someone's not going to pay me? Am I going to collect the full 100,000 on the receivable? So should I reduce that receivable? What did you say at first, though? You said expense? You said expense? You said expense, the chance that somebody's not going to pay me? In fact, we're assuming it's inevitable, right? And in fact, we're going to use our past experience based on the fact that people haven't paid us in the past. So we're going to say 1% of the time people fall on hard times and they can't pay us, right? Okay, so you're saying that's an expense? So what expense do you want to demonstrate? You want to debit the expense? Huh? You want to debit an expense? Okay, so we'll debit an expense. Let's say we call it bad customer expense. Aren't these bad customers that don't pay us? Okay, so we're just going to call it bad customer expense. How about that? And if we're saying 1% of the time they don't pay us, that's what? 1% of 100,000 is $1,000? Good. What do you want to credit? We debited bad debt, bad customer expense. You want to credit something? You want to credit the accounts receivable? Okay. Let's go ahead. Let's credit that accounts receivable for $1,000. Okay. Let's just do that. Credit the account receivable for what? 1,000. I know that's kind of hard to see here, guys, huh? What did it do? Oh, switch on me again. Thank you. Okay, so we credit the accounts receivable for $1,000. Okay. So let's go ahead and let's go with that journal entry. Okay. Now what? So now I'm going to sit here. I know I'm going to get out of this slideshow for this because I want to do things here, but all this information on this slide is not that helpful. So I can write on the side over here. Okay, so now I'm going to go ahead and I'm going to make up my financial statement. Okay, and let's say this was the only transaction that this company had. They purchased, they sold some merchandise. We'll just say they provided a service, whatever. But I don't want to get into the debit to cost of goods sold and all that. So they provided this revenue, this service for revenue, whatever, and they got an account receivable, and they set up this bad debt expense, right? So who wants to make me up the income statement based on this? Income statement. Do I have any revenues? Do I have any revenues? Sales, revenues, whatever? Okay, so I have revenue of what? Revenue of 100,000. Okay, good. Do I have any expenses? Okay, I have expense, the bad debt expense, bad customer expense. Bad C expense. What's that, 1,000? Okay, so that was the only transaction that I took as an expense, right? So what's my net income? Not a trick question. Net income is what? 99,000? Okay, good. That's my net income. Okay. Now, this company just started business, didn't they? They just started business. This is the first transaction they've ever had. So what's my accounts receivable? What's my accounts receivable? Accounts receivable is what? 99,000. It was 100,000, and then we credited it, right? And what's my liabilities or what? 0. They just started business. Liabilities are 0. So what's my, we didn't have any common stock here, so what's my retained earnings? Now what, we got purple here again? So what's my retained earnings? How would my retained earnings be 1,000? Okay, by now, guys, you have to know that assets equal liabilities plus stockholders' equity, right? I mean, if you're not knowing that by now, we've got a problem. So my retained earnings has to be what? My retained earnings has to be 99,000, and of course it is because what? We're sitting here and we've got the accounts receivable. We got the net income that what? Came down to my retained earnings through my closing entries. Okay. Okay, good. So we got the balance sheet, we've got the income statement now, don't we? Okay, and we've recognized the fact that there's a chance that some of these people won't pay me, right? Okay, now, we have a little bit of a problem, though, because when we create our accounts receivable that we debited here and we credited here, we're at the general ledger level. But we also have something called a subsidiary ledger that gives all the details of who our customers are. And so we've got customer 1, who bought stuff from us for $10,000 and owes us $10,000. We got customer 2 who owes us $10,000. We got customer 3 who owes us $10,000. I'm not going to write 10 customers, guys, but just assume that there's 10 customers and they all owe us what? 10,000. So my subsidiary ledger is showing me what? A total of my accounts receivable 100,000. Meanwhile, up here at my general ledger, based on these entries that I just made, I started out at 100, but then you told me to credit the accounts receivable for about 100,000. You told me to credit the account receivable for 1,000. So my what? My GL accounts receivable is showing 99, but I'm sitting here in my subsidiary ledger showing 10,000, right? 100,000. So we have a problem because our subsidiary has to match our general ledger, doesn't it? And which customer do you want me to take the 1,000 out of? I don't know who the person is that's not going to be able to pay me some amount at this point in time, do I? So I can't credit accounts receivable the way you wanted to because of this problem. Because if I can't credit an individual client's account, I can't credit the GL account for 1,000. But we've got to work around that. Instead of crediting accounts receivable the way you wanted to, and that was a good thought to credit the accounts receivable, since we're saying we're not going to collect it, but what we should have done was what? Credit the allowance. Credit an account called the allowance. I need to put the right cadence on that. Credit an account called the allowance. This is an allowance for the chance that somebody won't pay me. Okay, so since I credited the allowance, then my accounts receivable is not 99,000. It's how much? How much is my account receivable now? It's back up to 100,000. Good. And then I'm going to report an allowance right here against my asset, and the allowance I put how much in there? I put a credit of 1,000. The accounts receivable was a debit. The allowance was a credit, and so my net accounts receivable is now showing what? 99,000, isn't it? It's sort of like accumulated depreciation that we talked about before against contra to the asset account. It's reducing the asset account, so net it's showing 99,000. Does the balance sheet balance again? Does the balance sheet balance again? And now the world can look at my financial statements and say, I get it. You had $100,000 worth of sales, but you're telling me that based on past experience, there's a chance that 1,000 of that won't be collectible. So you took that as an expense against your sales. It's a normal course of business thing because what? If you offer credit to people, I promise you some people aren't going to pay you. That's just the way business goes. There's always going to be some people that won't pay you. Now, sometimes I'll get customers. I guess my students are my customers. Sometimes I'll get what? I'll get students that'll say to me, well, could you ever collect all of it? What situation would cause you where you'll always collect all of your sales? Good. If you do what? Cash sales, you know. Cash only. You put that sign up, you know you'll collect all of your sales there, right? But if you offer credit, there's going to be some people that won't pay you. Now, your other option is to sit there and pray for that they'll pay you. And while you're at it, pray for world peace too, right? And hopefully maybe both one or the other of those will happen. Okay? But probably neither will. Okay? Well, do we have an allowance set up for that? Do we have an allowance set up for that? Yes, we do, right? Because we anticipated it was going to happen. So now Billy Bob calls me and says, I can't pay you. Sorry, can't pay you. I don't know if you ever saw the movie Sling Blade, whatever. Billy Bob calls and says, okay, I can't pay you. Okay. Every time my dad and I watch that movie, then we got to spend the rest of the day walking around the house going, Okay, so what happens? So now he can't pay me, right? So since he can't pay me, let's say he can't pay me $300. Okay, what am I going to do? Well, I have an allowance for that, don't I? Okay, and so what I'm going to do is I'm going to go ahead And I can now write off his receivable. The accounts receivable, I can go ahead and credit, what I say, $300? Now I can credit accounts receivable $300 because I'm going to credit his account too because he told me he can't pay me $300, right? And I'm going to do what? This is why I set up the allowance. I'll go ahead and I'll debit the allowance. I set it up for just people like Billy Bob, didn't I? So I debit the allowance for $300, right? Now, if you were looking at the allowance had what? Just teeing up the allowance down here. Can you see that down there? Teeing up the allowance is pretty small, but I'm just teeing up that's allowance. And I had originally done what? Credited for $1,000, right? And now, because I had to write off that money from Billy Bob, I debited it for $3. And so there's a balance in here of how much now? $700. And so now, when I look at my balance sheet's going to show me what? Now I made the numbers really hard. What is it? 99,700? Those are really hard numbers now, right? 99,700 is what's in the receivable. And in the allowance, there's how much now? 700. My net account receivable is still showing at what? At 99,000 because I'm sitting there and I'm saying, well, look, there's still 700 of Billy Bobs out there that haven't shown up yet, right? Okay, and I just wait for the next Billy Bob. Okay? Okay. So this process that we're talking about here, guys, is called the allowance method. And so I just want to get us over and take a look now back at the next slide. And so when we have this allowance method that we're looking at, they tell us that when you have a sale, you're going to have to set up an allowance for uncollectible amounts, and that allowance is what? A contra against my asset accounts receivable, isn't it? Okay? And so if you take a look at, and the debit for the amount that I'm not going to collect is called, I called it bad customer expense. We call it bad debt expense, okay? Or you could call it uncollectible account expense. I like bad debt expense because uncollectible account expense sounds like a drunk accountant to me. Well, it's the uncollectible account expense, okay? So I like to call it bad debt expense, whatever, okay? Uncollectible account, bad debt expense are both acceptable terms, okay? Okay, so that was our debit, and we credit the allowance, okay? We call that the allowance method. We call that allowance method, and it is required by FASB, by Generally Accepted Accounting Principles. They're sitting there and they're saying to us, you must set up this allowance at the time of sale to recognize the inevitable economic event that if you offer credit to people, some people aren't going to pay you, right? Okay? Okay, good. Now, they also have something called direct write-off, but GASB, sorry guys, I got a little bit of governmental accounting dancing around in my head here because I'm teaching that class next. But FASB, Financial Accounting Standards Board, says what? Says that you can't use this, you cannot use this direct write-off method. This is not GAAP because it's a poor matching. Direct write-off says don't take the write-off until the person comes in and tells you that you can't pay. Well, if you look at that same example that we were just doing, if we have the sales of what, 100,000? Say that's year one. And we don't take the bad debt expense. We don't do anything because Billy Bob hasn't shown up yet, right? So we say the bad debt expense is 0. What's our net income? Our net income is 100,000, isn't it? Right? But then what? It's not until year 2 that poor Billy Bob realizes he can't pay us. And so we go ahead and let's say our sales in year 2 are 0. And we're sitting there and we're saying that our expense for our write-off, of course, we would credit the accounts receivable. The expense for our write-off is what? $300? Now we're showing what? A loss of $300 in year 2, but look, that sale happened a year ago, didn't it? So that's not a very good matching, because the thing that caused us to lose that $300 was that sale that we made on credit in year 1, isn't it? So we take the what? Bad debt expense and the allowance in the year of sale under the allowance method, and then we just sit there and wait for the guy to come and eventually not be able to pay us. That experience tells us they can't pay us. And if you notice, what happens? Oh, I wrote it on the sides. Did I lose it now? Probably. Maybe not. Did that side stuff stay? If I say keep, does it stay? Yeah, it did stay. And you notice right here, guys, notice that what? Notice that on my balance sheet, the write-off, the write-off had what? The write-off had no effect on the balance sheet. Look at that. Here was what? Well, I wrote over it, but before the write-off, I had what? I had $100,000 of account receivable. I had $1,000 of allowance. The net account receivable was $99,000, right? When I wrote it off, what happened? My account receivable came down by $300, but so did my allowance. The net receivable was still what? $99,000. So we simply reclassed out of account receivable into the allowance, but the net effect on the balance sheet in what? Year 2, presumably, when the person came to write us off, was of no effect, right? Net effect, it was 0 on the balance sheet. Why? The effect on the balance sheet was recognized in year 1 when we set up the allowance and the bad debt expense when the person had the sale, right? Okay. Okay, good. So that's where we're going with this. I want to delete this slide. That's sort of really an introduction to a large extent. When we present the allowance, we could do it the way I showed you, which is to show the account receivable gross less the allowance for doubtful accounts gives me what? Gives me a net accounts receivable of net of the allowance of $475. Or you could just simply do what? Just simply show the accounts receivable net, and then you'd have to footnote somewhere in your footnotes to your financial statement that there's this allowance, right? 2 different methods of presenting it. All right? Okay, so with that sort of as an introduction more than anything, let's now go through this in-class example. Okay, and this is going to give us sort of a detailed example here. I'm going to have up on the screen of how we would go through this entire process. So we're going to start the whole story over again now, making the sale on credit, and walk our way through and understand as we go along what's the balance sheet going to look like, what is the income statement going to look like. You have this on Canvas. If you didn't bring it, you can just look up here on the screen. You can pull it down out of Canvas later, and you can watch this again, right? Okay? All right, so let's just go ahead and let's take a look. And Buster's company had credit sales of $100,000 and estimates that 2% of the sales will not be collectible. Okay, and so we're going to want to account for the allowance and the bad debt. Now, I didn't put it on here, but let's go ahead and set up our sales too, right? So my sales is how much? My accounts receivable is going to be what? 100,000. And my sales are going to be what? Credited for 100,000, right? And this time, instead of it being 1% that not collectible, I'm saying it's 2%. Now, the company does this based on their past experience, based on information that they've collected in the past that's told them how much of their bad debt goes bad based on sales. Okay, I was on an audit of Wells Fargo, okay, and what they were doing was they were setting up their bad debt expense, and then they had these very sophisticated formula that they use where they look to see how loans migrated to I'll keep this. This is a Porsche pencil. Okay, so it did what? It showed how the amounts went to bad debt expense and all that. Okay, And so what's happening? If you sit there and you continually text to somebody else and you continually work on something else in your homework, I'm going to ask you to exit the class. Okay, so is that what you want to do? Okay. All right, so let's just stay with the material here, guys, okay? Because there's no reason for you to sit in here and text to somebody else. There's just no reason for it. Okay? And so they had very sophisticated methods of coming up with how their bad debts would what? Would migrate to how their sales and their loans and stuff would migrate to a point where they were going to have to take a bad debt and an allowance for that. So they can be very sophisticated as to how they do that. But in this case, we're just telling you it's 2% of your sales. So you have 2% of 100,000, and you're going to go ahead and debit the bad debt expense, and you're going to credit the allowance for that 2%, right? And you set that up at the time of sale. Okay? So you go ahead, you debit the bad debt expense, you credit the allowance for the amount that you think is going to go bad. And then we go ahead and when we prepare our, let's go ahead and do the income statement. I didn't put it in here, but let's put it in here. What's the income statement going to look like? Sales for what? No. Sales for, where are you getting 90,000 from? Sales for 100,000. What's my bad debt expense? My bad debt expense is going to be 2,000. Okay. And so my net income is how much? 98,000. Okay. And then I'm going to make my closing entries, and that's going to close out to retained earnings, isn't it? Right? And so when I show my balance sheet, and I'll just go ahead and write in the retained earnings part of it right here. Okay, we're going to show what? We're going to show the accounts receivable gross minus what? Minus the allowance for the bad debt expense, okay? Minus the allowance of 2,000, I should say, my bad debt expense amount, and I'm going to end up with a net accounts receivable of $98,000, right? Okay? Does my balance sheet balance? My retained earnings is showing exactly what it was supposed to, the 98,000, okay? What's your name? What is your name? Do you want to, if you want to work on something else, feel free. There's a library and all kinds of places for stuff like that. Is that what you need to do? If you need to do that, there's no reason for you to be here. You're much better off. You're going to be much more comfortable at the library. Would you like to do that? Okay. Okay, so what happens? We're sitting here and we have what? We have this 100,000 and we have the bad debt expense that we took of 2. My net income is 98. So I have my accounts receivable 100, my allowance of 2,000. That gives me my net accounts receivable 98. I'm assuming they don't have any liabilities, so my retained earnings is 98,000. It balances, doesn't it? Okay. Okay, good. Now we come down and I say a little later in the year, right here, a little later in the year, here comes Billy Bob, and he said that he could not pay $500 that he owed the Buster's company, right? So he was very upset that he couldn't pay us, and so he goes ahead and he does what? He debits the allowance for $500, and he credits the account receivable for $500 to write that off. Now we can credit accounts receivable because we know he's not going to pay us, right? And when we do that, what happens? If you look at the accounts receivable now, we originally had 100,000 in there. Let's just go ahead and tee up accounts receivable. We originally had 100,000. We just did what? Just wrote off 500. Didn't we just credit it for 500? So the balance in accounts receivable is 99,500. 99,500. Okay, so there's my balance in my accounts receivable, 99,500. If I look at the allowance, if I tee that up, allowance did what? It started with, what did I put in there originally? 2,000? and then I just debited it for 500, so the allowance has how much now? 1,500. 1,500's got 1,500 in it. So the what? Receivable minus the what? Allowance gives me a net account receivable of 98,000. What was it before? The write-off. It was 98,000, wasn't it? The net effect on the balance sheet happens at the time of sale. This could be, I say a little later, this could be in the next year potentially, right? We're going to assume in this example it was in the same year, but it could be in another year, right?
So if it happens in another year, it's still affected the
same exact journal entry. If this happened in another year, there was year 2 that Billy Bob came in, same exact journal entry. Okay? So we set up the what? We set up the allowance based on the sales at the beginning of the year. When the person comes in that we know is going to come in based on our past experience, we don't know who, but we know somebody out there is going to come in and say, I can't pay. And when that happens, we do what? We debit the allowance, we credit the account receivable to write it off, right? And the net effect on the balance sheet is just taking them out of accounts receivable, taking them out of the allowance to net it out to the same amount net accounts receivable, right? Okay? Now, what happens? Well, we take the amounts based on sales during the year, okay? But what happens is if the person comes back. What if Billy Bob hits the lottery and comes back, and the first thing he comes to us and says, I want to pay you back. I'm sorry. I was down on my luck, but everything's turned around for me now. And the first thing he does is rush in to pay us back, right? Okay, so what's going to happen? Well, if that's the case, then he's not the guy that we had put money into the allowance for. We put amounts into the allowance for people who what? Who really end up not paying us, right? And apparently he's not that person because he came back. That 2% is based on money we really have estimated that we won't collect based on our experience over the years, right? So what do? We go ahead and we put that money, 500, back in the receivable by debiting the receivable. We credit the allowance to do what? Take it and put it back into the allowance, waiting for that person who's really not going to pay me, right? Okay, and then because Billy Bob's going to pay me, I debit the cash and I credit the accounts receivable because he's giving me the 500 now, isn't he? So I reestablish the receivable, put that money back in the allowance for those people who really aren't going to pay me, and I do what? I go ahead and, of course, I debit the cash and I credit the receivable because he's actually paying me now, isn't he? I've got that cash. Okay. Okay, good. Then what happens? If you prepare the balance sheet now, we have 500 cash, we have 99,500 in accounts receivable, less the allowance. It was 15 because we credited it back and went back up to 2,000, didn't it? Right? So if you look, the net receivable is 97.5. That 500 that it's down is the 500 that we have turned into what? Turned into cash now. But if you really looked at my assets, if those are my only assets, I'm still at 98,000, right? So this whole thing of writing off, coming back, recovering, giving the money back to me, all of it had zero net impact on the balance sheet, right? The only time it had an effect on the balance sheet was at the time of sale when I took the bad debt expense, right? It matched against the sale. Okay? Don't worry, I'm only going to give you like 10 or so questions on the exam about this, so go ahead, tune it out. Okay? Okay, good. Now you come over. Question? Yes, sir. Well, if everyone pays you all of the money, then you consider that a highly unusual year, and you sit there and you wait for the storm that's about to probably come next year. You would close it out if world peace broke out and everybody paid you, which is not going to happen, right? The other way you would close it out is if you got past that first year and everybody paid you and you said, we're so lucky, we're taking our money and we're going home. We're going to sit here and we're going to only do cash sales from now on. Then maybe you could take the amount out. But as long as you're still offering credit sales and as long as there's still receivable out there, you leave that money in there waiting for the inevitability that someone's not going to pay you.
What were to happen if the allowance amount was too small?
Good. Perfect question. Let's go ahead. Because this was all during the year, wasn't it? All this happened during the year. We set up the allowance. Billy Bob came in. We wrote it off. He came back. We recovered it. We put it back, right? That was all during the year, wasn't it? But at the end of the year, we have to analyze what's in our accounts receivable and see if we're satisfied with the amount that's in the allowance. Because if we made all those sales, pretend we made all those sales on January 1st, let's say, right? Okay, and what's happening? We start to come to the end of the year, and some of those people have paid us off, but some of the people still haven't paid us off. So what happens? We'd have to analyze the accounts receivable, and we would do something called an aging of the accounts receivable. And with an aging of the accounts receivable, we're going to place amounts into different categories. So what happens? If we have somebody who's 1 to 30 days past due, we put a certain amount in the allowance for them. If we have amounts that are what? That are more than 90 days past due, notice we do what? This is a horrible example of an allowance. This is the worst stupid thing I've ever seen. There's a total of 600 due from this person. This is the stupidest allowance example ever. Aging I've ever seen. If I was auditing somebody, they were doing their aging like this, I'd say, are you nuts? Okay, the way they're doing this, and the reason I'd wonder if they were crazy, is we have this T.E. Albert who owes us a total of 600, and 300 of that is what? Is still pretty much current, isn't it? But what? Another 300 of that is getting quite overdue. And the problem I have with that is, why did we still loan this guy money if he owed us 600, had through $100 it was 90 days overdue? It doesn't make any sense. So this is kind of a weird example, okay? But look, don't worry about this up here. This is stupid. Notice right here, the amounts that what? Are not yet due, they only put what? 2% in the allowance for that. Amounts that are what? 1 to 30 days past due. I guess these are our past due amounts. They put 4%. For 31 to 60, they put 10%. For what? For 61 to 90, they put 20%. And then when you get down here for the amounts that are 90 past due, they're putting what? 40% in there. In other words, the longer past due you are, the more they put into the allowance for you. Okay, so by the time we get to the end of the year, we're doing an analysis to see where everybody stands in terms of their catching up on their paying for us. And if they're behind, we start putting additional amounts in the allowance to make sure we have it covered, right? Okay, so what happens? If you come over then and you go back to this example that we were looking at, I guess I'll discard that. Okay, we say that we are looking at the allowance, and right now there's how much in the allowance? There's 2,000 sitting in the allowance, right? We had what? We had put in 2,000. We got it down to 15, but then because he paid us back, we got it to what? Back to 2,000. There's 2,000 sitting in the allowance. And then what? Then we go ahead and we do an aging of the accounts receivable. And based on an aging of the account receivable, we determine that we need an additional $800 in the allowance. So if we need an additional $800 in the allowance right now, what would you say we should do to put the additional amount that we need in the allowance? No? This gentleman right here? The purple striped sweatshirt? We need 800 more in the allowance, don't we? Right? We got 2,000 in there, don't we? We got 2,000, but we looked at the aging, and there's people that are falling behind. And we're saying, hey, 2,000 is not enough. What do you want me to do? I thought 2,000 was the amount that I wanted to put in, and but now people are falling behind in their accounts. I want to put more in the allowance. What do you want me to do to put more in the allowance? Why would I debit cash? Cash has not been involved in this transaction at all. Accounting is not a Picasso painting. Okay, so we don't just start, let's put the push person's head over here and the body over here and let the people figure it out. Okay, so it's got to all line up. Okay, well, why are you crediting the allowance? Let me ask you that. Because you want to put more in there. You want to increase it because you're saying you need 800 more, don't you? You're saying you need 800 more? So you credit the allowance for that $800. Good. There's that credit. And when we credit the allowance, we debit what? We debit bad debt expense, don't we? Because we're putting an additional amount in the allowance? Because apparently we hadn't put enough. At the beginning of the year, we thought what? We thought 2% was cool. And then something happens. I don't know. The economy gets bad. Trump gets elected president. Everybody starts going crazy and not paying their bills because they're saying, we don't have to pay our bills because Trump said it's a rigged system, whatever. And so what happens? They stop paying their bills. And now we're looking going, uh-oh, these people are falling behind. We need more money in that allowance because they don't know what's going on out there, right? And if you look at what FASB says, they direct companies to do just that. Not only are they supposed to look at how their loans are migrating to their status, but they also need to look at economic factors to finally, at the end of the year, make an adjustment for what needs to be put into the allowance. And so they take a look and they say, you know what? We need 800 more in there. And they stick it in. Once you put that 800 more in there, you got to debit something. You debit bad debt expense. So on the exam, if I sit there and I ask you what's the bad debt expense for the year, you should be able to tell me that the bad debt expense for the year is what? 2,800. It's the original 2,000 we put in, 2% of the 100,000 of sales, plus that extra 800 that we had to kick in at the end, isn't it? Okay? Yes, sir. It's based off the company's experience, and like I was saying earlier, when my office audits the regulators, and then the regulators look at the banks, okay? But because we were looking at how the regulators look at the allowance for banks, they then offered us their work papers, and that's how we got access to the way Wells Fargo did it. And B of A were the two that we did out here in San Francisco, and we kind of led that work out here in San Francisco because we had two big banks out here. And so when we looked at that, we looked at all of that process, and it was a very sophisticated process where they showed how the loans migrated, how they and they had years and years of data. I mean, this is why God made computers, right? They had years and years of data as to how the loans migrate to bad debt depending on how delinquent they are. And then they added in economic factors, etc. Okay? What we didn't like that they do is once they had gone through all that sophisticated process, then they went ahead and added a little bit more into the allowance. And the regulator said, okay, they're just being safe. We looked at that from a different standpoint. If I put a little bit extra in the allowance today when things are good, then what? Then when things are bad, maybe I decide not to put quite as much into the allowance, and I'm still justifying that I have enough in there, right? And so what's happening? I'm steadying my bad debt expense so it's nice and smooth year after year, isn't it? Because markets don't like this kind of trend with revenue. They want to see a nice, smooth revenue trend, don't they? So our point was you're managing profits if you sit there and you just decide to stick a little bit more in the allowance, and the little bit more that you put in is based on what you want your net income to be for the year. My office, GAO, don't play that. No, that's not okay. You may get that one past the regulators because they like you to put a little bit more on the allowance. You don't get that past us because we have this bigger picture of the overall financial markets and the regulation of the financial markets. So we criticize them for that.
So when they would put more in the allowance,
It would make their income smaller, yes, this year. And so that's why the regulators were kind of like, okay, make your income smaller, right? That makes a more conservative picture, right? But our point was, yeah, but what happens if in a couple of years things aren't quite so rosy and the revenues are coming down? Then they could justify, well, look, the allowance has been a little inflated. Oh, look at this. The allowance has a little bit too much in it, so let's not take as much bad debt this year. And what happens? Now they get to smooth their profit out. That's a no-no. You don't make those kind of decisions. You guys heard of Bernie Sanders, right? Bernie Sanders said the other day that they said, well, Bernie, how can we stop this fraud? And he says, because the whole system is fraud. The system is based on fraud. You can't stop it because the system is based on fraud. The system is based on this idea that you try to get crap like that past people, and if you get past it, good. If you don't, then you say, oh, sorry, and you stop doing it, and you pay a fine. Okay, that was Bernie's point, not mine.
So just like confirm, so if you wanted to put $800 into the allowance account, it would be a credit and then accounts receivable?
No, debit to bad debt expense.
Oh.
Yeah, debit to receivable comes when we have the sale. The debit, anytime you credit the allowance, the debit is to what? Is to, well, I shouldn't say that. Anytime you credit the allowance, the debit is to bad debt expense unless we have a recovery. And if we have a recovery, then what? Then the debit would be to accounts receivable because we're putting the money back in the receivable and we're putting the amount back in the allowance. Okay, but when we have to increase the allowance like this, the debit would be to bad debt expense. Okay? Now, you take a look, and at the end of the year, the busters determined that they only needed $1,800 in the allowance. I probably told my story too soon because it would be much more poignant now if I had already pointed out if I had already done this, then you'd really understand that story a little bit better. And that if they determine that they need $1,800 in the allowance, and there's how much in there? $2,000? No, this is a different, pretend now like there was $2,000 and they determined they only needed what? $1,800, right? And there's $2,000 sitting there, so it's a different set of facts. Now, if you say you only want $2,000 in there, then what? Then you're going to have to debit the allowance for $800, aren't you? To bring it down to $1,800? What do you mean 200? Oh, 200 is the debit. Yeah. Okay. Thank you. Sorry. Yeah, you're right. Sorry. We're going to debit it for what? Thank you. For 200, right? And that's going to bring it down to what? 1,800, right? Thank you. Sorry, guys. That's going to bring it down to 1,800? Is that what you're going to say? Yes, you would. It's right there in front of you. Debit the allowance for 200, and we bring down the bad debt expense because we said, oops, too much. We had put too much in. So we need to take a little out now, don't we? Okay? And so at any point in time, you get to the end of the year and you look at the allowance and there's a little bit too much, you take some out, right? And if you've done a nice job sneakily building up a little bit more, a little bit more, put a little bit more. What's the income this year? Okay, put some more in the allowance. We're still okay. Put a little bit. Oh, wait a minute. Put on the brakes. The net income isn't looking too good. Don't put as much in. Here's a nice steady profit. And all of a sudden, your financial statements are not reflecting the economic reality of what's going on with the company, right? Okay?
So your net income will be 200 more.
My net income will be 200 more than what I thought it was going to be. Now, again, I'm having this all happen in 1 year, but this could happen over the course. Imagine that happening over the course of several years, right? And you can sort of sit there and step on the gas, apply the brakes accordingly if you just decide to put amounts in the allowance because you're satisfied with your net income, right? Okay?
Okay. So if they had increased it to 800, so now it's at 2,800, and they decided that they didn't want it to be that high in year 2, would they be able to lower it, or would they just leave it 2,800 and see where?
Well, let's pretend like we had 2,800 sitting in there. So let's just go back to that example. So we had the allowance, and how much do we have sitting in there? We got this $2,800 sitting in there, right? That's scenario 1 that we had. Okay, and then we go into year 2, and in year 2, now they've determined, you know what? We put that 2,800 in there, but we think that our collectability is actually 1%. Okay, so what happens? They go ahead and they put now an additional 1,500 into the allowance, don't they? Right? Okay, so how much is the allowance now? That's year 2 now. 4,300 is sitting in the allowance? Huh? Yeah. I debited the bad debt expense. I credited the allowance. This is year 2 now because I made more sales, so I put more into the allowance, right? Right? Okay. And now one of those guys, remember those were people that was 10,000? Every sale, let's say, was worth 10,000. So one of those guys comes in and says, "I'm busted. I'm going down, man. I'm going to jail. I can't pay. So I'll see you in 10 years when I get out. You don't want to know." And I'm like, "Really? Yeah." Huh? I don't think so. He's 90 and he's telling us he's going to jail for 10 years and he owes us. I saw this TV show one time. Have you guys ever heard of Sanford and Son? It's an old TV show, and they're at a funeral, and they're saying all this wonderful stuff about this guy. And then they start going into the thoughts of each person. And one lady says, "He cheated on me." Okay, that's what she's thinking about while they're saying all these wonderful things about the person. And then they go to this guy, and the guy's sitting there, and you're thinking, what's he going to say? And he says, "He owed me $50. Okay, so what's going to happen? You know, some people we're not going to collect from, right? Okay, so what happens? We're not going to get that money out of that guy, right? Okay, guys, do they have couches in the library? Go grab one if you're that tired. When I took my first accounting class, there was this guy, he'd always start fidgeting like 10 minutes before the class. And one day I'm like, "What's wrong with you? Why do you all start getting all nervous when class is about to get over?" And he says, 10 more minutes and I get to go sleep in the library. Okay, so if you need to sleep in the library, go for it. Okay, so let's say that one of those guys, don't pay me, right? Okay, or I'll tell you what, even better, if you don't like me calling you out for sleeping, let me know when you're going to teach a class, and I'll come and I'll take a nap during there. I'll just sit in the back of the room snoring, okay? All right, so what's happening? We're sitting here, and what? One of those guys can't pay me, right? One of those guys can't pay me. So what happens? If he can't pay me, I have to credit the accounts receivable, don't I? For $10,000? And I have to do what? Debit the allowance for $10,000 because he can't pay me, right? Isn't that what the allowance was for?
Yes.
Is that what the allowance was for? And so when I debit the allowance for $10,000, what's the balance in there now? What? It's a debit balance of 5,700?
Yeah.
So now I'm looking at the allowance and I'm sitting there going, oh man, I really don't have enough in there now, do I? So what do? So now I'm sitting there saying, I better put a little bit more because I'm pretty sure that there are some people that are also getting hurt by this economic downturn or whatever it is, right? So you know what? I better put another, I don't know, I'm going to put another 10,000 in the allowance in case some more of these people come in. And so when I credit it for 10,000, now it becomes what? Back up to 4,300? Okay? It's an estimate, guys. You put in there what you think you need at any point in time, right? And when you what? When you take amounts out, you debit the bad debt expense. When you what? Feel that you don't need as much, you can take it out by crediting the bad debt expense, right? Okay? Okay, good. So with all that, let's go ahead and let's just play jazz with this a little bit. Going to put the allowance over here. Tee up the allowance over here. Okay. I have sales of 100,000. 1% is not bad. Journal entry is going to go bad. And I'm going to put bad debt expense right here. Sales of 100,000. 1% is going to go bad. What journal entry? Credit the allowance for 1,000, you say, sir? Okay, good. If I credit the allowance for 1,000, what do you want me to debit? Bad debt expense for 1,000? Right? Okay. I have another sale of 200,000. 1% is going to go bad. What do you want me to do? I have another sale of 2,000. 2% is going to go bad. What do you want me to do? What did I say? 2,000? 200,000. Debit the bad debt expense for 2,000? 2% of those sales? Credit what? I don't know. 200,000. 200,000 and it's 1%. We'll stick with the 1%. 200,000, it's 1%. So what are we going to do? Debit the bad debt expense 2,000, credit the allowance 2,000, right? Right? Okay, good. A sale of 500,000. 1% is going to go bad. Debit bad debt expense for 5,000 and credit the allowance, right? For 5,000? So I debit bad debt expense 5,000, I credit the allowance 5,000, right? And what? I got sales of 100,000, 200,000, 500,000. So my accounts receivable is what? 800,000? Accounts receivable is 800,000, right? And right now I've got about 1% in there, don't I? Okay, now I age my accounts receivable. And based on an aging of accounts receivable, in fact, let me collect on some of my accounts receivable. So, no, let me not. Accounts receivable is 800,000, right? I age my accounts receivable, and based on my aging of accounts receivable, I determine that, and I put them in these different categories, I determine that 3% of that 800,000 is going to go bad. Now you're saying, well, when you did the sale, you said it's 2%. But yeah, that was at the beginning of the year when I made the sale. Now I'm in a situation where I'm towards the end of the year and I'm starting to know that people are starting to be late on paying me, aren't they? So I determined that I need to put 3%. So if I have 800,000 of sales, how much do I need in the allowance if 3% of that's going to go bad? I need 24, and I have how much in the allowance? Well, that's not right. How's that possible? Something's not right.
Because you were doing 1%, now you want 30.
Yeah, so I should have to put more in there, not less.
That's 24,000.
Oh, I need 24,000 in there. Okay, and how much do I have? 8,000. So I need what?
16.
I need 16,000 more in the allowance, don't I? Okay, so since I need 16,000 more in the allowance, what do? I credit the allowance for what? 16,000, and I debit the bad debt expense, don't I? For that 16,000? Right? So I take amounts during the year based on the sales, and then at the end of the year, I do an analysis of the account receivable, and I adjust at the year end, don't I? For what I need in there? Okay? Okay. All right. There's that exercise. Let's do something else. Let me take that 16,000 out. And let's say that somebody tells me they can't pay me. What am I supposed to do? I have this money sitting in the allowance. Somebody comes and tells me they can't pay me, I don't know, $1,800. They tell me they can't pay me. Huh? Debit the allowance. What did I say? 1,800? For 1,800. And credit what? Credit the accounts receivable for 1,800, right? Because they're not paying me. I'm writing it off. I credit the accounts receivable. I debit the allowance. Okay? So now I have what sitting in the allowance? Balance. 8,000, huh? Say again? 6,200? Okay, so there's 6,200 sitting in there, right? Okay, good. So now I do an aging of my accounts receivable. And let's say I collect some of this receivable. So I collect and I'm going to debit cash for 500,000, right? What did I say, 500,000? I debit cash for 500,000 and I credit my accounts receivable for 500,000, let's say, right? Okay, so now I'm sitting there, and in my accounts receivable, I have 800,000 minus 1,800 is
798,200.
minus 500,000 is how much? 298,200, you say? Is the balance in here? Like that? 298,200? 298,200? Okay, so I got 298,200 in there now, right? And I look at that and I determine that I need half a percent of that amount. 0.5% of 298,800. $14,910? 1,410, you say? 1,491, you say? Is what I need in the allowance? How much do I have? 6,200 right now? So what do I got to do? Why do I have to add more if you just told me I need 1,491 and there's 6,200 in there? I got to take some out of the allowance, don't I? How much? Huh? 4,000 what? No, I'm saying that I need 1491 in there. I've got 6,200. How am I going to get down to 41491, whatever it is? 4,000 what? 700.09. So I debit the allowance for 4,000. 4709, and I credit what? Credit the bad debt expense for 4709, because apparently I took too much at the beginning of the year, didn't I? Didn't I? I took too much because what? I collected a lot better than I thought I was by the time I looked to the end of the year, and so I brought that percentage down to what? 0.5%, didn't I? Okay? So again, this whole exercise was what? Make sales during the year. We put amounts in the allowance based on the sales, didn't we? During the years we have write-offs. We write them off what? Against the allowance, don't we? Debit the allowance, credit the account receivable. And then at the end of the year, after everything is starting to formulate for us and everything's starting to shake out as to how we're collecting, we do what? We make a adjustment at the year end, don't we? To our best estimate by the year end, putting what we need in the allowance, and then we go into the next year, and now we're putting them up in the allowance for those amounts that happened in year one. Now we start to make sales in year two. We put amounts in the allowance for the sales that happened in year two. Now we got some of those year one ones that are getting written off against the allowance. That's okay. Taking them out of the receivable, taking it out of the allowance while we're making additional sales. We come to the end of the year. We look at what's in there. Some of it is last year's sales. Some of it is this year's sales. Maybe for the ones from last year's sales that were made in December are starting to get really old, so we better put a little bit more in the allowance for them using that aging account thing that we saw. The later they get, the more we put in. And we keep going year to year with this mess, don't we? Trying our best to come up with an estimate of what's going to be collectible, right? But the process is, as you make sales, you take the percentage that you think you're not going to collect, you debit the bad debt expense, you credit the allowance in the year of the sale, right? Then you go through the years, writing off against the amount you put in the allowance, making an adjustment at the end of the year for what you think you're not going to collect, going into the next year, the next year, the next year, right? That's the process that we're describing here, and now you know why I kept waking you up. Because if you concentrated on something else or you slept through it, there's absolutely no way that you will understand this. Okay? So what we need to do is take a look and let's see what happens with a couple of homework questions. Perfect. We'll do a couple. Question? Yeah, it's in the video. That's why I have this stupid thing on. So if I stand over there and go nuts, it still gets recorded. This whole thing that I just did on here? The whole thing is in there, yes. It's in there, and then you can sometimes they're not right on the screen. But yeah, everything's getting recorded unless the audio fails on me like it did last time. You mean this thing? This mess? Uh-huh.
Over there by the bottom left, you said debit allowance for 1,800.
Yeah.
And then instead of crediting BDE, you did something to the account receivable.
We credit the account receivable because we write off against the account receivable.
But how come you didn't do anything to the bad debt expense?
Because we took the bad debt expense for those inevitable write-offs in the period when we did the sale. We debit the bad debt expense for $1,800. We credit the allowance for the amounts we think we're not going to collect. And then as we actually don't collect those, we debit the allowance and we credit the account receivable so that it's a wash on the balance sheet, right? Remember the balance sheet kept showing $99,000 even after Billy Bob wrote it off, right? So bad debt expense gets hit at the time of sale. And then when we write it off, we go ahead and we write off against the allowance. Now, if we change our mind, if by the end of the year we have better information in order for us to estimate what needs to go into the allowance, then we go ahead and we make an adjustment to the bad debt expense, right? That's at the end of the year when we're making an adjustment. Okay? All right, so you come over and you take a look at this example. And we have Buster's Company began business on January 1st, 2014. During the year, Buster's had credit sales of $100,000 and estimated that 2% of its sales will not be collectible. So if we have 2% that's not collectible, what journal entry do we make? Debit the bad debt expense for $2,000, right? And we do what? Credit the allowance for $2,000. Okay? And so if we're looking at the allowance has how much in it now? Has $2,000 in it. And this question was asking me what? What is the bad debt expense? Did we get it right? Right? Okay? Okay, good. Take a look at number 2 now. Question number 2 is Billy Bob told the Busters that he could not pay 1,000 of the accounts receivable. The journal entry to write off the bad debt is going to include, and I'm showing you, we're going to credit the accounts receivable for the 1,000 that the guy can't pay, right? Right? What's the debit to? The debit is to the allowance. That's why we have the allowance, so we can write stuff like that off, right? So we go ahead and we debit the allowance for 1,000. So how much is in the allowance now? 1,000 is in the allowance, and our bad debt expense is still showing at 2,000, isn't it? The write-off did not affect the bad debt expense. The sale affected the bad debt expense, didn't it? Right? Okay. Okay, good. Then we come down and we say assume that the transactions from 1 and 2 were the only transactions that could have potentially affected the allowance account. Based on an aging of the account receivable December 31st, 2014, Buster's determined that they actually needed $1,800 in the allowance. Well, how much is in the allowance? There's 1,000 sitting up there in the allowance. I want what? 1,800 in there, don't I? 1,800, so I have to credit the allowance for what? There's already 1,000 in there. Why would I credit it for 1,800? I want to credit it for what? 800, right? So I go ahead and I credit the allowance for 800, and I have to credit what? Bad debt expense. Debit bad debt expense. Thank you. I have to debit bad debt expense for 800, don't I? Right? And so if you look at the bad debt expense, which they're saying, what's the bad debt expense for the period? It is what? It is the original 2,000. I probably should have teed up bad debt expense. It's the original what? The original 2,000 that I had stuck in there right there, right? The 2,000 during the year with the sales plus what? Plus the 800 year-end adjustment, right? You make amounts during the year plus the year-end adjustment, right? Isn't that the process we've described? Okay. Now you come over and we need 2,800. Oh, that's it? What a jip. Okay. I was thinking maybe I had a write-off there, but I guess not. Okay. Now, take a look at the rest of the allowance questions that are in the quiz. Don't worry about some of these notes, although frankly, you already know how to handle the notes receivable because we did that in another chapter when we were doing adjusting entries. So really, you can actually look at what? Look at all of the homework. Look at everything. Look at everything for this chapter 7. Go through it. We'll hit this at the beginning of the class, and then we'll jump into chapter 8, okay? Assuming we have time. Okay? 6, not 5. We went through 5. We're skipping 6.
Monday in class you did chapter 5 quiz?
Yes. Yeah, we're all caught up so that we start chapter 7 today.
Thank you.
Yep.